Last year, when most investors were watching their stocks plummet, one Wall Street legend had an unfair advantage that was identifying winning stocks with massive upside. Like Riot Blockchain before it shot up 10,090%, Digital Turbine before it shot up 789%, Overstock.com before it shot up 1,050%. This power gauge comes from the legendary Mark Chaikin. Right now, you can get a free in-depth look at how his power gauge system works, a way to type in any of 4,000 different tickers and see exactly where the stock is most likely to go next and in any type of market. Simply go to powergaugepreview.com for a free look. Again, that's powergaugepreview.com. Welcome to Making Money. This is Matt McCall. Thanks for joining me. It's the 7th of April, 2022. It's a Thursday. And we got a bit of a special show for you. We're going to take a look back at Q1 quickly because, you want to learn from the past, but we can't drive a car looking in the rearview mirror. Then we're going to look ahead. And I have 10 stocks that I want you to add to your watch list for the second quarter and beyond. Some really small stocks, some names you might know, some names you've never heard of. We're going to talk about that and much more. And right now, just so you know, I'm at the Bitcoin conference in Miami. Next week, a full breakdown of what I came across at this very large crypto conference. All this coming up right now on Making Money. Again, folks, thanks for joining me. This is Matt McCall. It is April 7th, 2022. It is a beautiful Thursday down here in Miami. I am at the, getting ready to go, I should say, to the big Bitcoin conference. And I mean, over the years, I've been at this in the past, and it gets bigger and bigger every year. It's almost like a Lollapalooza of finance. It is nuts, like the Coachella of finance. It's a big festival. People get all crazy and dressed up. And I will say the one nice thing is, I could wear my button-down shirts with some jeans and fit in nicely. It's not a typical conference where you have to wear the suit and tie and all that kind of jazz. So it's really nice to be able to just fit in and feel comfortable. Plus, it's Miami at this time of year. It's pretty damn hot down here as well. So today's show is actually taped yesterday on Wednesday. And the reason for that is because I am going to be so busy Thursday, Friday, even Wednesday afternoon when I'm done with this, and through the weekend kind of catching up with anything and everything Bitcoin and cryptocurrencies. So don't worry, on Tuesday's show, I'm going to put together a nice breakdown of what I came across, people I ran into, and really my big picture thoughts on Bitcoin and cryptocurrencies in general, not only for the next week or two, but for the next several years, and where I think that fits into an asset allocation plan for the average investor. But before we get to that next week, I want to take a look back on Q1. And I talked about this a few times with you all, and I think it's time to finally do it. And I want to take a look here at a chart of several ETFs that track specific trends and sectors and how they performed during the first quarter of 2022. And as you can see in the chart, there is a wide range of returns, from as high as nearly 38% to a loss of 30%. And let's start with the outliers right now. As you can see up top there, the gain of nearly 38%, that is XLE, that's the energy ETF. We all know oil prices have been spiking, affecting inflation directly. A lot of that has to do with what's going on in the Ukraine and Russia right now. It doesn't matter what President Biden says. It's not the Putin tax on oil or whatever the hell he calls it on gas. Oil prices were already going up. And they're going up because we were starting to see the global economy reopen. I mean, January is still kind of weird when it came to COVID, but we've seen really everything start to open up again. As the economy reopens, there's more people flying. I fly almost every week. Airlines are packed. They're expensive. So people are flying, obviously more demand for energy, more people going back to work, more offices turning on their lights, more demand for energy, more people driving to work, more demand for energy, more people just getting out and doing things, more demand for energy. So yes, the situation in Ukraine or Russia add to it? Absolutely, folks. but we were already on the rise prior to that. So it had a huge quarter. That's a basket of some of the largest stocks, ExxonMobil, Chevron, etc., up about 38% in a quarter. On the downside is the ARK Innovation ETF, symbol ARKK. And I am one of the biggest proponents of innovation and disruption and change going forward in the next 1 to 10 to 20 to 30 years. And I believe that it will continue. Innovation cannot be slowed down. That being said, innovation from quarter to quarter, from year to year, will have times where the stocks get out of whack on the upside and out of whack on the downside. I think right now we are out of whack on the downside. That being said, you can always go a little bit lower before you turn around. I think there's a lot of great opportunities, and I'm going to talk about that in a moment when we look ahead. But you know, down 30%, could it be down 40 or 50% year to date at some point? Sure, it could be. But at some time, and I'm not saying you buy the ETF, folks, I'm saying you look at individual stocks that are considered innovative stocks. And I think that you're going to see a lot of great opportunities right now for long-term investors, not traders, for long-term investors. So let's just kind of take a look at the rest is kind of jumbled here in the middle. The orange there up 7.8%. That is aerospace defense. And that really kind of took off mid-February, or late February, I should say, when the conflict started. So that to me is a direct play on the conflict. You move down a little bit further, the gold up 5.6%. Again, kind of a direct play on the conflict as well, and inflation. Utilities up 4%. That's a safety play. Again, you look at back in February when the conflict started, it was down. Now, quarter to date, or so I should say year to date through the end of the first quarter, up 4%. Consumer staples, again, that's a bit of a safety play, down 1.6. The S&P 500 was down 4.9. Let's call it 5% for the quarter. The Russell 2000 small mid-cap index was down 7.7% for the quarter. And then the second worst performer in this list, down over 14.5%, was biotech. I see great opportunity in biotech down here as well on this pullback. So I really just kind of wanted to show you that, to kind of see the dispersion of gains in a matter of 3 months, not 3 years, but in 3 months. How you can see the difference between investing in energy and in innovation. This is a 68% or so, but a 68% difference in 1 quarter. And I'll be honest with you, I didn't own any energy stocks, and I'm not planning on buying any right now. I'm a little late to the game, in my opinion. But oil could stay high for a little while, but I just don't see that much more upside coming when it comes to oil right now. So that's kind of where we stand here, looking back at the first quarter. You know, for the S&P, going back to 1945. So let's do the math. That's 55 plus 21. You know, it's obviously 76 as the year is born. So of the last 76 years, the first quarter was the worst, the 12th worst first quarter ever for the S&P 500. And history shows us that typically when you have those rough quarters like that, we will typically have a bit of a bounce back in a second quarter and for the remainder of the year. We'll see. I mean, I think we're going to have a very choppy rest of the year, but I think we're going to see some pretty big rallies along that way. And I think at some point in the next 3 to 6 months, we will see the S&P hit a new all-time high. So I think you want to be positioned for that as well. April, which we're in right now, is typically the best month of the year for stocks. I talked about this about a week ago, but starting out a bit shaky. So it's definitely not starting out the way that you think it would. The average gain since World War II for the S&P 500 in the month of April is 1.7%, and it's up 70% in time. That's more than double the average gain of any other month out there. So you can see that is usually a big month for the market here in April, but it doesn't mean it's going to be up. I just like to throw those stats out there. It doesn't mean it's going to be up just because of that. One other chart here I want to show you, kind of looking back. This is the first quarter. This is the iShares S&P 100 Value ETF versus the iShares S&P 500 Growth ETF. And as you can see, for the Value ETF, it was down about 0.5%, whereas the Growth ETF was down 8.7%. And it was down much more. It's down about 18%, the Growth, that is, and the Value is down about 6%. But again, big money going into value versus growth, and growth has been really underperforming, in my opinion, for the last 6 to 9 months after leading for many, many years. So the bit of the rotation I get. That being said, what I'm going to talk about today, I'm going to share 10 stocks with you, which in my opinion are growth stocks, but also trading at really nice valuations. So we're going to kind of meld the two together. And that's what excites me about this list that I'm about to share with you here in one moment. A couple of headlines that we need to be cognizant of heading into the second quarter and really for the remainder of the year. The one right now that kind of catches everybody's attention for many reasons is what's going on in Ukraine. How is this going to end? Will it end anytime soon? What is Russia's ultimate goal here? A lot of that's unknown, and the market hates unknowns. All that being said, I believe that the market has gotten to a point where we're a bit numb unless something dramatic happens. And you see that happen oftentimes in geopolitical issues. I remember going back to 9/11. I was a stockbroker at Charles Schwab in Denver. I was on the desk that day that happened, unfortunately. It was a couple years before I moved to New York. And very rough day, but you notice day after day after day, week after week, people became more numb to headlines of potential attacks and eventually future attacks. One in Madrid and other places, London. It just didn't hit the market the same, as horrific as they were. And I think we will see the same type of situation play out here with Ukraine, Russia. Hopefully it gets settled, but I think you could potentially see the same type of numbness from investors. So that's one headline. Another one is obviously inflation. Oil prices as well, which kind of goes hand in hand with inflation. That's going to play out, and also kind of tied to Ukraine and Russia as well, as I mentioned earlier. Interest rates, the 10 years at nearly 2.6%, multi-year high, hit that just this week. What the Fed will do, obviously, the next meeting's in early May. Odds are we're going to have a 50 basis point rate hike. And I think this craziness that we saw this week is baking in a lot of rate hikes. And again, a lot of this is baked in for me. The other thing we saw this past week was the inversion of the yield curve. We saw the 210, which means you're getting more interest, higher yield for the 2-year versus 10-year. Typically that precedes a recession, but it doesn't happen for 18 months. Typically precedes a high in the market. Again, doesn't typically happen for 18 months. And in that 18-month time frame, we have a rally of nearly 30% on average over the last couple of decades when this happened. So it doesn't mean you go sell now. We're also in a very different situation where inflation's super high now. Typically it's not when you see this inversion. So I'm not saying this time's different. People who say that typically get burnt. But I'm saying it's something to be cognizant of. And then obviously looking forward, I showed you value versus growth. I think we need to keep an eye on that because when it comes to value versus growth, we could see a switch back to growth pretty quickly coming ahead. Now let's take a look at this chart. This is kind of a stock picker's market chart in my opinion. And this goes back to what they call the GFC, the Great Financial Crisis back in 08, 09. And the green line is the average of the stock dispersion. And just to keep it simple, this basically shows the spikes in this show when it's a stock picker's market because it means there's not as a less correlation of picking stocks. Where lower it is kind of just invest in the market. Most stocks move in tandem. And we can see a major spike in 2020 here, 2019, 2020. And that obviously was right when, or right before and right during the COVID pandemic. So you can see that spike there. I mean, that was ridiculous. And going back, we had one in 2015 as well. And we had another one here in 2020 in the middle of the pandemic. But you can see how high it's getting again. We're getting back to that level, in my opinion, where we are in a stock picker's market. Meaning you can't just invest in an ETF. You can't just invest in technology, any technology stock or any semiconductor stock or any electric vehicle stock. It's going to be a situation where you have to truly do your homework, and that's what I'm here for, to help our subscribers and to help our viewers right now. So what I'd like to do is go through 10 stocks that I have on my watch list. Again, none of these stocks are buy or sell recommendations. They never are. I have no exposure to any of these stocks right now. But they are ideas that I think that you could put to your watch list and see if they fit into your investment style. And they're all over the board, but they fit themes. And the themes are growth and value. And a lot of people say you can't have both. I disagree wholeheartedly. I think you could have a growth stock that's trading a nice valuation based on historical numbers or based on just the fact that it's overlooked because it's a small company. So let's dive into it. And these are in no specific order at all. The first one that we want to take a look at here is a company called Twin Disc. The symbol's twin, TWIN. As you can see, really nice looking chart. It recently broke out to a yearly high, pulling back to that 16 level. I'll zoom out here and show you a little bit longer chart. It's kind of forming this base over the last couple of years and starting to break out. I really like the action just purely on the technicals in the chart. It's about a $224 million company. They do power transmission equipment for marine, so boats, and heavy off-highway vehicles, so big kind of construction vehicles. The revenue growth isn't huge, but what I see here, which I really like, what makes it a value play for me, and a growth play as well, is the earnings per share. Last year lost about 70 cents a share. By 2023, so in a matter of 2 years, next year, it's estimated to make 40 cents a share. So it's turning profitable at a very high rate. And the way the chart's setting up right now, boy, this looks like a really nice entry level from a pure technical perspective. The next stock we're going to take a look at here, number 2, is Playa Hotel and Resorts, symbol PLYA. It's a $1.4 billion company. They have 22 resorts in Mexico and the Caribbean. So this is a bit of a reopening play because, as you can imagine, as more people start traveling, they're going to go back to very sunny, warm places. And domestic travel has really picked up in the United States as people feel more comfortable flying within the confines of the States. And a lot of people never make their way overseas, over the Atlantic or the Pacific, to see other continents. I think that this travel will continue to pick up. Revenue obviously dipped during COVID with a lot of shutdowns, but we see revenue increasing up to nearly $900 million by 2024, and that's very nice for a $1.4 billion company. And by 2023, just next year, 30 cents a share in earnings per share, and for an $8 or so stock, again, a nice valuation, what we're seeing here on a stock that is considered a growth stock. The next one is going to be the smallest one on the list, and this is Assure Holdings. It's a recent IPO going back to September of last year. The symbol is IONM, and it's about a $69 million company. What I find fascinating about this is it's in a very niche area that I think we're going to see a lot of growth. It deals with surgical procedures for the nervous system, so it provides the technical aspect of that. But at the same time, it also provides human capital, the technicians that actually use the technical equipment for these procedures. And as we all know, there's quite the shortage right now when it comes to healthcare workers. So they're definitely filling a niche. They're expected to turn profitable next year, which is really fascinating for a company that is only worth $69 million right now. Revenue in 2020 was $3.5 million. Revenue expectations next year in 2023, $50 million. So that is a huge growth in just a matter of 3 years. So this is one I clearly under the radar. Doesn't trade a lot of volume. It is very, very aggressive. Again, nothing is a buy or sell recommendation. But I'm just saying this is a very aggressive stock. But again, it's in a very niche area, overlooked, that if it really starts coming on people's radars, this could be one that really takes off. Next, we're going to completely shift, and we're going to go to a topic that I talked about earlier this week on Tuesday, and this is LNG, liquefied natural gas. And this is Golar LNG, symbol GLNG. This is one of the more popular LNG stocks out there. It's about a $2.7 billion company, and they provide infrastructure for the liquefaction, the transportation, and then the regasification of LNG, liquefied natural gas. Revenue is only expected to grow about 9% annually for the next couple of years. But where I really find huge value and growth is that the company lost money in 2021 last year. This year, 2022, expected to have earnings per share of 76 cents. And by 2024, just 2 short years from now, the earnings per share estimates for $2.51 a share. And again, for a company that's trading around 24 bucks, that means it trades with a forward P ratio of the next 2 years of less than 10. That's value. There's also growth there as well. And again, LNG, liquefied natural gas, in my opinion, is going nowhere. It's going to continue to pick up, especially as Europe and other countries try to get off Russian oil, which I think is a no-brainer. Riot Blockchain is the next company. I've talked about this one in the past, I believe. Symbol's Riot, R-I-O-T. And this is one of the bigger Bitcoin miners out there. As I mentioned, I'm going to be doing a show next Tuesday that is going to be post-Miami Bitcoin conference. Riot Blockchain is worth about just over $2 billion right now. Revenue last year, $213 million. Next year, so in over 2 years, expected to go up nearly threefold, or over threefold, I should say, to $721 million. Earnings per share in 2023, looking for $1.55 from 70 cents this year, so more than double. So again, huge growth, but also nice value because based off those earnings per share next year of $1.55, it's trading at about 12 times earnings, which again, for a company that's such a high growth company, is a nice valuation. But keep in mind, this stock and most Bitcoin miners or anything related to Bitcoin will typically trade with the price of Bitcoin. So if Bitcoin pulls back, more likely than not, this will. That being said, if Bitcoin breaks a new all-time high above 69,000, this stock should be a rock star. So keep that in mind. Next one is a little bit bigger. It is a $4.6 billion company. I guess that's going to be in the mid-cap range. And this is Surgery Partners, and the symbol is SGRY. It's about a $51 stock, and as I mentioned, $4.6 billion. It is an owner of a network of surgical facilities. And it's rare because most of these networks of surgical facilities, these more independent ones such as Surgery Partners, either are private or have been bought up over the years by big name companies. This one has not yet been bought up. I likely believe it will be bought at some point. That being said, I never recommend a stock because I think it's going to be a takeover. It's just a bonus that's on there. It trades at a price of sales of 1.6. So again, that makes it very ripe for a takeover. Its earnings per share are supposed to increase the next 3 years on average 57% a year. From a loss this year up to 88 cents a share in 2024. So again, you're seeing a really nice growth and a decent valuation. As I mentioned, this is one that we really could see a takeover at some point in the very near future, in my opinion. Let's shift over now to a company that's kind of a niche, and symbol CMCO. This is Columbus McKinnon. And this falls into the industrial sector. It makes a lot of intelligent motion solutions for all types of industries. It also is in the farm industrial niche area as well. It's breaking down on the chart, hitting a 52-week low this week. That being said, for the $1.1 billion company, revenue expected to come in 2024 of about $1.1 billion. So right around what it's worth right now. So it trades about 1x sales estimate of 2024. Last year it came in $649 million. Well, last year it earned $1.16. The estimate for 2024 is for earnings per share of $4.19. So trading at less than 10 times earnings. Again, folks, I look at some of these stocks and they are truly cheap. Could they get cheaper? Yes. So let's look at a chart here of CMCO as we're looking at, but let me zoom out a little bit here for you. You can see here, this is a breakout to a new high in 2021 and pulling back from there, kind of right on a chunky support level around 40. Could have hit 35 and still look great? Yeah. So that'd be, let's call it a $5 pullback from here. So what's that, about 12%? So your downside to me is 12%. Your upside is probably 50 to 100% in the next few years. So I like my odds there, and I like the way it sets up. But again, do your own research. The next two companies we're going to take out a little bit bigger, or we're going to take a look at a little bit bigger. The first one here is Li Auto, and let me get this chart set up here for you. Li Auto is symbol LI, and this is one of the, let's call it the big three Chinese electric vehicle companies. And it's got a bit of a choppy chart. You see the big sell-off here in March, and that was when everything in China got hit, and it bounced back pretty quickly. I did a show right around that. But it's holding up pretty well. It's a $28.5 billion company. And this to me is a company that it's a great way to play the largest and the fastest growing electric vehicle market in the world. And that's not going to end anytime soon. In 2020, it had sales of $1.37 billion. Last year, that jumped to $4.18 billion. This year, they're looking for $8.15, and next year, $13.71 billion. So you are seeing enormous growth on the upside. And when you think about that type of growth, it's tough to ignore. And then you look ahead to 2024, and from 2023 to 2024, you're looking at growth that's going to be put it up in the $20 billion range, in the low 20s. And again, that's a couple years out, so it's tough to kind of look at that. But that is something that is truly, I think, going to happen. It is expected to turn profitable this year. We always want to see a path to profitability. So even looking at price of sales going forward, just on next year, it's around 2. When you have sales growing like this, price to sales ratio of 2, that is a good value, folks. The wild card here is that when you think about Chinese stocks, will they be delisted? Will they not? I think the odds are that they will not, but I'm not an expert on that. So I will bet on them not, but if that's the concern, then you want to stay away from a company such as Li Auto here. The next is a semiconductor company, and the symbol is GFS, and this is Global Foundries, a company that went public in October of last year, around $40. It shot up to 70, back down to 40, back up to nearly 80, and we're back down now to the mid 50s. So it's been kind of all over the place. It's a bit of a bigger company versus a lot that I've talked about, just under $30 billion market valuation. It's a semiconductor foundry, which is where the name's Global Foundries. It manufactures ICs that enable electronic devices in basically every sector of the economy. And this is an IPO that was, I think, overlooked a bit. It generated about $4.85 billion in sales in 2020. This year, looking for $7.8 billion. So decent growth here on the top line. Bottom line, the company lost about 5 cents last year, but estimated to make $1.84 this year, $2.53 next year. And that is where you see the huge upside in this company, where you take a look at just the bottom line. And again, this is huge growth, and based off those earnings per share estimates, it's not a bad valuation either. And again, that's what I'm looking for here. Long-term growth, but also with good valuation as well to go with it. So number 10 here, the last stock we're going to take a look at for your watch list for Q2 and beyond is CLAR Corp, symbol CLAR. This falls into the leisure area, outdoor equipment, lifestyle type products. They sell their equipment all over the place. Everything from pants to rock climbing footwear to different harnesses for rock climbing, helmets, ice climbing gear, backpacks, you name it. People getting outside and being active. It's usually under the Black Diamond brand name, so you may have heard of it. It's sold at a lot of different places. They also have the brand name Sierra and Barnes that they use for ammunition and hunting, military, law enforcement. It's a company about $845 million company. You can see in the chart here, it's kind of been going sideways for a few months after trading near an all-time high. I like this because I don't think that trend that began during the pandemic is going to end anytime soon. That trend saw people getting more outside. And if you look at sales in 2020, they were $224 million. Last year, it shot up to $376 million. By 2023, well over $510 million. And I don't see this stopping anytime soon. 2024, over $600 million. And what's nice about this company is we want to look at the bottom line. When it comes to companies smaller like this, make sure they're making money or have a path to profitability. They made $1.47 last year. This year, looking for $1.76. Next year, $1.87. So not huge growth on the bottom line. But by 2024, we should be close to over $2 a share. And again, for a company that's trading at $22, that's 11 times earnings on the downside. So this was a bit of a motley crew of stocks. Most were small to mid cap, in my opinion. Almost all of them have very great growth prospects. Almost all of them trade at really nice valuations based on either today or their future growth prospects. And again, you want to think outside the box and look at these companies. And these are ones you want to put on your watch list, because we don't need to find what the big winners were last quarter and do that, and what the huge losers were and try to catch a falling knife. Let's look at just companies that are really flying on our radar. And there's a lot of great growth companies that are right now. And once the market gets back to normal, and what is normal these days, but back to actually evaluating stocks for what they're worth. And that goes back to the stock pickers market I talked about, folks. And in the stock pickers market, you have to think outside the box. You can't be buying what your neighbors or your family members or your coworkers are saying. You need to think independently. And the only way to think independently is to do some research. And I know it's very tough to do that when there's so much time in a day. And as you can see here, I'm doing a lot of research here for you. And don't forget, you can always sign up for our newsletter for $49 a year. We have portfolios. Every month we give you brand new stock ideas, oftentimes more than one stock idea per month. We recently did one on batteries, my favorite 4 battery stocks. So we have a lot out there. We have a lot more coming. It's going to remain volatile. Just keep that in mind. But again, keep your focus on the long term. Nothing in life happens in days or minutes or months or quarters. It takes time. Anything good that comes to you takes time. Same thing with making money in the stock market. So keep your head straight, stick to your strategy, and if it bothers you, go out and do whatever makes you happy, whether it's surfing, whether it's going for a run, having yourself a nice cocktail, going to see your grandkids. I am going to sneak out and play some golf here this afternoon for the conference, and I'm going to not think about the market for a few hours. And that's okay. It's okay to do that because the market's not going anywhere. The market doesn't give a rat you-know-what about you. Keep doing your research, keep your head straight. And again, there's 3 things that we're trying to achieve in this show. We're going to educate you, number 1, first and foremost. We're going to have fun while we do it. And number 3, we're all going to end up making some money at the end of the day. So thank you so much, folks. Remember, Tuesday, I'm going to have the complete breakdown of what I saw at the Bitcoin conference, maybe some footage I'll get there as well, at least some photos, and let you know what's come out of one of the largest Bitcoin conferences in the world here in Miami. So we'll be back on Tuesday. Have a wonderful, safe, happy weekend. Go tell somebody you love them, give them a hug. Spread the love, folks. Thank you so much for watching, supporting the show. I'm Matt McCall, and that was Making Money.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.